Hello and welcome to Calmvestor podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. The market is always moving, always changing, but not all these movements are the same. Some are like massive ocean currents, powerful and enduring, while others are just surface ripples, temporary and fleeting. Imagine an investor in the early 2000s who recognized the internet was more than a fad. They invested in the underlying technology and reaped rewards for decades. This was a secular or long-term trend. Now, picture another investor who sold all their quality stocks during a short economic downturn, mistaking a cyclical dip for a permanent decline. They missed the subsequent recovery and long-term growth. Have you ever wondered why some industries or companies seem to grow phenomenally for decades, while others shine brightly for a short period and then fade away? The key often lies in understanding these two types of trends. Distinguishing between these big waves and ripples is fundamental. As Benjamin Graham wisely suggested, investors must differentiate between temporary market fluctuations and long-term structural changes. Let us dive into what these trends really mean. A secular trend is a major transformative shift that can last for decades, even centuries. It reshapes how we live, work, and interact. These secular trends are driven by profound, fundamental forces. Think of groundbreaking technologies, significant demographic shifts, climate change, or enduring macroeconomic policies. Their growth is often sustainable and their impact widespread. Examples include the ongoing shift towards renewable energy, the development of artificial intelligence, or the economic impact of an aging global population. These are not fleeting moments but deep currents. On the other hand, we have cyclical trends. These are shorter-term fluctuations, typically lasting a few months to a few years. They are often tied to economic cycles: growth, peak, recession, and recovery. Cyclical trends can also be linked to specific industry events. They tend to be repetitive and are influenced by temporary factors. Importantly, they can and do reverse. Consider the rise and fall of commodity prices like oil or metals, or the tourism industry's recovery after a global event. Even seasonal stock price movements around earnings reports are cyclical. The core difference lies in duration, the driving forces, and the sustainability of the trend. For instance, the electric vehicle industry represents a secular trend. It's a long-term shift. However, within the secular rise of electric vehicles, the industry might experience cyclical trends. These could be supply and demand imbalances or price competition among manufacturers, but the overall secular growth continues. So why is it often challenging for investors to distinguish between these two? One major issue is the noise from short-term information. We are bombarded with daily news and minor stock price movements. This constant barrage can make us lose sight of the bigger picture. It is easy to get caught up in the immediate, the urgent, and miss the important long-term shifts. Then there is FOMO, the fear of missing out. Many jump into hot cyclical trends without fully understanding them, often buying at the peak only to sell at a loss when the cycle turns. Impatience is another hurdle. Secular trends unfold over years, even decades. They will have periods of cyclical downturns or corrections. Holding on during these times requires conviction and patience. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." This is especially true when navigating secular and cyclical trends. Investors also sometimes confuse a cyclical recovery with long-term secular growth. A stock or an industry bouncing back from a crisis does not automatically mean it is set for sustained, multi-year expansion. Predicting the exact start and end points of any trend, whether secular or cyclical, is incredibly difficult, if not impossible. This uncertainty adds to the challenge. What are the root causes of this difficulty? Human psychology plays a significant role. We are social creatures, prone to herd mentality, easily swayed by the actions and emotions of the crowd. Cognitive biases also cloud our judgment. Confirmation bias leads us to seek information that supports our existing beliefs, ignoring contradictory evidence. This can be very costly. Anchoring bias makes us over-rely on initial information, like a stock's previous high price. Overconfidence bias can lead us to overestimate our ability to predict market movements. The market itself is incredibly complex, influenced by countless interconnected factors. Clearly separating secular drivers from cyclical noise is not always straightforward. The financial media often adds to this confusion. Media outlets often focus on daily volatility and short-term narratives, which can be distracting for long-term investors. Philip A. Fisher noted the value of seeing through majority opinions to find underlying truths. So how can we effectively identify and invest based on these distinctions? The first step is deep research and cultivating a long-term vision. Focus on the fundamentals. This means analyzing macroeconomic factors, technological shifts, demographic changes, policy directions, and societal transformations. Ask yourself, what will the world look like in 5, 10, or 20 years? Evaluate a company or industry's business model and its sustainable competitive advantages. For example, with electric vehicles, look beyond quarterly sales. Research global adoption rates, battery technology evolution, charging infrastructure, and government policies. The investor who bought Amazon early on did so recognizing the secular trend of e-commerce and cloud computing, not just because of one good earnings report. That is long-term thinking. Secondly, historical analysis and data interpretation are crucial. Look back at past economic and market cycles. Which sectors were heavily affected? Which proved more resilient? Compare growth patterns. The growth curve of a secular trend typically looks different from the up and down volatility of a cyclical one. Be wary of the phrase, "this time is different," if it lacks solid backing. For instance, history shows that consumer staples often weather economic downturns better than cyclical sectors like real estate or construction materials. The dot-com bubble showed that even within a secular trend like the internet, many individual companies can fail due to flawed cyclical business models. Thirdly, embrace diversification and patience. Diversify your portfolio to mitigate risks from unfavorable cyclical trends affecting specific sectors. You do not want all your eggs in one basket. Patience is paramount for secular trend investing. You must be willing to hold through short-term volatility. The buy and hold strategy often aligns well with capturing secular growth. Consider using dollar-cost averaging, investing a fixed amount regularly. This strategy helps reduce the risk of bad timing, averaging out your purchase price over time. Think of an investor in a global technology, ETF. They understand technology is a secular growth story. They accept that the fund might dip in some quarters due to cyclical factors, but trust in its long-term potential. As Anthony Robbins and Peter Malek remind us, the market might look bleak short-term, but it tends to recover long-term. Investing is like planting a tree, not trading commodities day to day. In conclusion, correctly identifying and distinguishing between secular and cyclical trends is like having a reliable compass for your long-term financial journey. It guides you towards sustainable success. It empowers you to be a wise investor, one who looks beyond the immediate horizon. It encourages you to dedicate time to research, to think critically, and to resist the pull of the crowd. Investing in secular trends might sometimes feel less exciting than chasing hot cyclical stocks. However, it is this disciplined, patient approach that often yields substantial and sustainable rewards. Warren Buffett's advice to be fearful when others are greedy, and greedy when others are fearful often means recognizing long-term secular opportunities when cyclical pessimism is high. Consider those who patiently invested in foundational tech companies after the dot-com bubble burst. They reaped immense rewards as the secular trend of technology continued its powerful advance. So take a moment to review your own investment approach. Are you primarily chasing temporary fads, or are you building a portfolio based on enduring, future-shaping trends? Perhaps dedicate an hour each week to researching macroeconomic shifts rather than just watching daily price charts. What secular trend do you believe will significantly shape our world? Thanks for listening. If you found this content valuable, do not forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.